Good afternoon, everyone. I am CA Nitin Gupta, Chairman of ICI Agri Branch CRC, the moderator of this webinar. We are delighted to welcome you all to this webinar, which is being organized by the Continuing Professional Education Committee of ICI. Please block your calendar on Wednesdays and Fridays to get insights into various emerging and high-value technical topics. It is my pleasure to be a moderator for the webinar on concept of real income under income tax and opportunities for CS in Agri Infra Fund and PMFME. In a short while, we will start this webinar. First, I would like to apprise you about the CPE committee. The role of a chartered accountant is evolving continuously to accept newer responsibilities
तिवारी
in
जी
a
मुझे
dynamic global environment.
1 minute नितिन
जी
Ji,
sir.
sir.
president sir has called me. You
Okay, sir.
continue. I will join later.
Right, sir. Right.
Sure, sir. Sure, sir.
So Nitin ji, chairman sir
Yeah.
will be joining, afterwards. So meanwhile, we can continue as usual, sir.
No problem,
Accept
sir.
that part. Right, sir.
So should I start from the beginning or
No, it's
can I
all
continue?
right, sir. We are live.
Okay, sir. So the role of I was telling about the CP committee. The role of a chartered accountant is evolving continuously to
Nitin ji,
accept
one
your.
second.
Ji,
One
sir.
second, just request.
Ji,
May I
sir.
request tech support team chairman sir ka I think camera on. Yeah, it's all right, sir. Please. Nitin ji, continue.
Okay.
Sorry.
So no issue, sir. So I was telling about the CP committee. The role of a chartered accountant is evolving continuously to accept new responsibilities in a dynamic global environment. The future of CS depends on being flexible and open to innovation. Therefore, the need of the hour is to innovate as per the requisites of the contemporary business environment and accordingly upgrade the curriculum and education system of chartered accountancy course. The committee also believes that members of ICI should look beyond the traditional areas of practice and seek and explore new areas of business and profession, and hence, the CP committee is mentoring the members by providing guidance through various workshops, seminars, national conferences, background materials, etc., and simultaneously by encouraging young and dynamic professionals to grow as speakers, masters of ceremonies, etc., in CPE programs. The program for this evening is as follows. We have two sessions of 1 hour each, and the topics are the concept of real income under income tax, principles and significance. Second, opportunities for CAs in Agri Infra Fund and PMFME. Our eminent speakers will talk about the above mentioned two emerging areas of professional interest. The medium of communication will be in English. So I request everybody to kindly maintain the medium in English. And now I would like to since the chairman sir is not with us, sir, should I carry on with his profile?
Yes, sir. Please carry on, sir. Whenever chairman sir would be free after the meeting, as was suitability while taking the topic by Nikhilesh ji. So
Okay.
accordingly, he may address. Meanwhile,
So,
sir, you
sir,
please proceed.
so I will welcome in and read his profile whenever he's available, I guess.
Yes, sir.
So, should I start with the first session?
Right, sir.
Right, sir. So our first session is being taken by CA Nikhilesh Kataria ji, who has experience of over 20 years specializing in direct taxation. He was the chairman of the direct tax community at both ICI and the Tax Consultant Association, Jaipur. He has taken many sessions at professional forums and also published articles in leading tax journals and magazines. He is also an active contributor to the profession as a life member of AIFTP, RTCA, and TCA. So now I would like to welcome CA Nikhilesh Kataria for his deliberation.
Thank you, Nitinji. First of all, I'm extremely thankful to Satish Gupta ji, Chairman CP Committee, who actually himself have a very deep understanding on the subject of income tax, to given me this opportunity to share my views on the topic. Also present Shri Vishnu Kumar Agrawal ji, Vice Chairman CP Committee, Ajit Nath Tiwari ji from CP Committee, Nitin Gupta ji, Chairman Alwar Branch. Today we have a little unconventional topic in our hand, concept of real income. The purpose to take such topic was that if we look at any law, then it is 50% the statute books, which is passed by legislatures, and 50% is the interpretation of the statutes, which is made by the High Courts or Supreme Court of the nation. So understanding from the perspective of judiciary gives you 100% understanding and knowledge of the subject. The topic which we are going to discuss, you won't find in rule books. Rather, it has been derived from the judicial pronouncement, which have been given by the court of the land from time to time. As the chargeability provision in the new tax regime also remains the same, the relevance of the discussion which we are going to do today would be equally valid for the next regime also. So that is to be kept in mind. So first, let us first understand what income is. Before coming to the concept of real income, what is income? So I'll straight away go to the definition of income. 224 defines the income. So there is a list of around 18 items, and this covers profit and gains, dividend. I have just kept in short voluntary contributions received by a trust, any special allowance or benefit, any allowance granted to the assessee to meet his personal expenses, the value of any benefit or perquisite, whether convertible in money or not. These are related to salary. Then the value of any benefit or perquisite, whether convertible into money or not, obtained by representative assessee. Then we come to the charging section of business or profession. Then any sum chargeable to income tax under clauses 2 or 3 of section 28 or section 11 or section 59. Then we have 3A, 3B, 3C of 28, which are covered here. Then we have the value of any benefit or perquisite taxable under clause 4 of section 28. Any sum chargeable to income tax under clause 5 of 28. Then sixth entry is capital gains chargeable under section 45. The profit and gains of business or insurance carried on by mutual insurance company, cooperative society, banking company, any winning from lotteries, crossword puzzles, races, any sum received by assessee from his employees as contribution to any fund, then some received under keyman insurance policy, fair market value of inventory referred to in clause 6A of section 28. Then the sum referred into income from other sources, section 56, which are covered here with entry number 13 and 14. Then again, the sum of money or value of property referred to in clause 7 of 7A of subsection 2 of section 56. Any consideration received by issue of shares as exceed the fair market value. And then we have any sum of money referred to in clause 9 of subsection 2 of section 56. And few more entries are there which are related to income from other sources. Now, this list has evolved over the period of time as the law grows and the passing of judgment by the apex court, and the revenue thought it fit to cover here. But still, I will come to first line itself, income includes. So this is not something exhaustive definition. This is inclusive definition. Even beyond this list and the chargeability provisions in different heads, there can be income which may be treated as income for the purposes of taxation. So essentially, there is no definition of income as such, exhaustive definition. Even if we go to the Constitution of India, the central government gets right to taxes on income from entry 82 of list 1 of 7th schedule. This entry reads as follows: taxes on income other than agricultural income. So again, there is no definition of income as such. So we have to take support of the judicial pronouncement of the Supreme Court, which is as good as the law of the land. My attempt would be that I take you to journey of decisions rendered by the Supreme Court, which are very important on this aspect in last 60-70 years, which will give you understanding of the income and real income which we are talking about. Now, the lead judgment on the subject is from Privy Council in 1943. This is Raja Bahadur Kamakhya Narayan Singh of Ramgarh versus CIT 11 ITR 513. This was the time when capital gain was not there, and only business income and other income was chargeable to tax. What Raja has done, that it has given its mining lease to somebody, and it has got mining lease income, mining royalty. So the claim of the Raja was that this is not having character of income, because what I have done, what Raja has done, that parting away with the capital asset. And as the capital asset is deteriorating, there is no income which has accrued to him, and rather this is the consideration of the capital asset which has taken place. There, the Privy Council, when the capital gain was not being taxed, has held that income is not necessarily the recurrent return from a definite source, though it is generally of that character. Income may consist of a series of separate receipts, as does in the case of professional earning. The multiplicity of form which income may assume is beyond enumeration. And lastly, they have held that income is impossible to define, and it is of the broadest connotation. Where you get regular return, it will be income. While holding all this discussion, it was held that it will be deemed to be income, and the Privy Council has considered it to be compared it with like fruits of the tree, which will be available to the assessee over a period of time, and it was deemed as income. Then there were, as and when these heads of income was introduced in the Act, there was a different writ petitions before the apex court challenging those introduction of the new levy, sometime capital gain, income from house property. So challenging to capital gain, there is a decision in Naveen Chandra Mafatlal versus CIT 26 ITR 758. What the Supreme Court has held, the argument founded on an assumed legislative practice being thus out of the way, there can be no difficulty in applying its natural and grammatical meaning to the ordinary English word income. As already observed, the word should be given its widest connotation in view of the fact that it occurs in the legislative head, conferring legislative power. So this was Naveen Chandra Mafatlal, Supreme Court.
Sorry to interrupt. I would just request you to kindly share your screen, sir. The PPT is not visible as of now.
The PPT is no. Oh, I just thought this was shared. Just a moment then. Is it visible now?
It's visible, sir. You can carry on, please.
Is it there?
Yes, sir. It's there.
Okay, fine. So this was the decision in case of Naveen Chandra Mafatlal, where the challenge to capital gain was held to be not valid. Then there was introduction of income from house property, where the self-occupied property was also brought to taxation. Question arose whether the saving of expenditure can be income, because there the court has observed that when you are living in your own house and not other house, then you are effectively saving on the rent which you might have paid, and even that was treated as income. The part of the judgment which was delivered in case of Bhagwan Das Jain versus Union of India 128 ITR 315, it reads, even in its ordinary economic sense, the expression income includes not merely what is received or what comes in by exploiting the use of property, but also what one saves by using it oneself. That which can be converted into income can be reasonably regarded as giving rise to income. The tax levied under the Act is on the income from house property in the above sense and not on house property. from house property, not from house property and not on house property. And this is within the powers of the legislative competence. So again, that challenge was not held to be valid. Then there was a case when deemed income was introduced, and the clubbing provision, which in old Act 16(3) of the Act, presently we have Section 64. So it was challenged, and in the case of Balaji versus ITO and others, 43 ITR 393 Supreme Court, it was held that even though it is not assessee's own income and it is the income of the maybe the daughter-in-law or the son, but still it has close nexus with the assessee, and therefore it will be held to be the income. And the challenge to the legislative provision was held to be not valid. This and the observation which was made, this mode of taxation may be little hard on a husband or a father in case of genuine partnership with wife or minor children, but that is offset to a large extent by the beneficent results that flow transformed to the public. Then in case of Navneet L. Lal C. Jhaveri versus KK Sen AAC 56 ITR 198 Supreme Court, applicability of deemed dividend was held to be valid. Then in case of A. Sannyasi Rao, Union of India versus A. Sannyasi Rao 219 ITR 330 Supreme Court, the presumptive taxation under Section 44, 44 AD, 44 AC was held to be valid. And it was held by the Supreme Court that considered in the light of the practical difficulties envisaged by the revenue to locate the persons and to collect the tax due in certain trades, if the legislature in its wisdom thought that it will facilitate the collection of the tax due from such specified traders on a presumptive basis, there is nothing in the said legislature measure to offend Article 14 of the Constitution. Now, the very interesting decision on this subject of defining what is income, two decisions are important and which can be noted down by the listeners. ED Sassoon and Company Limited versus CIT 26 ITR 27 Supreme Court, and thereafter a very well celebrated judgment in the case of CIT versus Shurji Vallabhdas and Company 46 ITR 144. Now, in ED Sassoon and Company, what has happened that the assessee was managing company for the 3-4 principal companies, and it was selling goods on their behalf. During the year, it has transferred its managing agency. Let's say it was working from April to December, and from 1st January onwards, it has transferred its managing agency. Now, the condition in the agreement between the managing company and ED Sassoon was that the commission would be due at the end of the year and accordingly will be paid. Now, the assessee has transferred in 1st of January. The consideration was received after March, and the person to whom the transfer was made, he has received for the 12th of the month. 12 months agency commission because it was due at that time. So for 9 months, ED Sassoon and Company worked, and for the 3 months, assignee to whom the agency was transferred has worked. In the case of the assignee, the assessment got completed, and there the argument was found to be valid that he is liable only for the 3 months because there was no working for the 9 months from the April to the December. And even though the consideration has been received by him, still he would be liable to be taxed only for the commission which was due for the 3 months. And there the claim was found to be valid. But on that ground, the reassessment of the ED Sassoon was reopened that at least somebody has to pay taxes because ED Sassoon has not paid taxes because the claim was that it has not received any commission and the agency was transferred in between. And because the agency commission gets due on the 31st March, therefore he is not liable because there was no accrual of the income. While rejecting the submission of ED Sassoon, the Supreme Court has held that though there was no commission which has been received by the ED Sassoon, but here there is a continuous and successive functioning of the managing agency for the 9 months, and therefore the income would be taxable in the hands of ED Sassoon and company, and it was held in 26 ITR 27. But very interestingly, in the subsequent decision of Supreme Court, in the case of Commissioner of Income Tax, Shurji and Shurji Vallabhdas and company, it's a very interesting decision. I will read out what have been held by the Honorable Supreme Court, 46 ITR 144, and it has got all relevance in understanding the different heads of income. Now, in this case, what has happened that the assessee was earning commission from certain freight companies and shipping companies, and 2-3 companies commission was he is earning, and in the mid of the year it has decided that he will be transferring the business to some other companies, private limited companies, and it will forego what commission. In this case also the commission was due at the end of the due and payable at the end of the year, not in between the year. So then the condition of freight companies was that it has to forego some of the commission what has been earned by him. So instead of 10% commission, the commission was revised to 2.5%. That the assessee would be receiving only 2.5% as against 10%. What has happened in between that, let's say in December it has made entries on the basis of 10% receipt of income commission, and in March when all that was revised, then that commission was reversed, and only for entries were made with 2.5% commission. Now the case of the revenue was that the income has already accrued to the Shurji Vallabhdas and company, the assessee, and accounting entries have been made, so it has to pay taxes at the rate of 10% on 10% of the commission and not 2.5%. And for that the ground of ED Sassoon and Company Limited was taken. But here the court has taken a contrary view, and I may read out what the Honorable Court has held, that income tax is a levy on income. No doubt the Income Tax Act takes into account 2 points of time at which the liability to tax is attached. That is the accrual of the income or its receipt. But the substance of the matter is the income. If income does not result at all, there cannot be a tax, even though in bookkeeping an entry is made about a hypothetical income, which does not materialize. Where income has in fact been received and is subsequently given up in such circumstances, that it remains the income of the recipient, even though given up, the tax may be payable. Where, however, the income can be said not to have resulted at all, there is obviously neither accrual nor receipt of income, even though an entry to that effect might, in certain circumstances, have been made in the books of accounts. Then the court continues to go on held. A mere bookkeeping entry cannot be income unless income has actually resulted. And in the present case, by the change of the terms, the income which accrued and was received consisted the lesser amounts and not the larger. This was not a gift by the assessee firm to the managed companies. The reduction was a part of the agreement entered into by assessee firm to secure a long-term managing assessee arrangement for 2 companies which it has floated. So in this case, and this is a landmark judgment which is being followed in many of the cases, that entry in the books is not decisive of the true character of the income. So this was Shurji Vallabhdas and company. So from this discussion, what appears that the income is a widest connotation, and there is no limitation which has been put, and there is no interpretation which has been put in section 224, and it has to be seen from the individual instances. Morvi Industries Limited versus CIT also an interesting decision, 82 ITR 835. Now, in this case, what has happened that the commission assessee was getting commission. It was due on every 31st December, but it was payable at the time of AGM. So again, just compare the fact of Shurji Vallabhdas and Morvi Industries, you will come to know that how the income is derived in judicial sense. So what has happened that the commission was due on 31st December, but it was payable at the time of AGM. What has happened for 1 year that the assessee made entries in the books of account regarding commission accrued, but before the AGM, it was communicated by the company that this time we have lost, so we will not be in position to give you that much of commission, and accordingly the decision was to be taken. So between the AGM and the 31st December, when it was stated to be accrued, it has foregone its commission, and accordingly the entries were made. So there the court has came with the different finding. Court has held that the accrual and payment, accrual is nothing to do with the payment. And even if the assessee gets or unable to gets the lesser amount or even unable to recover the amount, still it will not affect the accrual of the income and it will be taxable. So precisely court has said that the postponement of the date of payment has a bearing only insofar as the time of payment is concerned, but it does not affect the accrual of income. The moment income accrues, the assessee gets vested with the right to claim that amount even though it may not immediately. There also arises a corresponding liability of other party from whom the income becomes due. Further fact that the amount of income is not subsequently received by the assessee would also not detract the accrual of the income, although non-receipt may in appropriate cases be a valid ground for claiming deduction. So you can very well claim the deduction for bad debts, but it cannot be said that there was no accrual of the income. So the fundamental principle which arise, assessee once earned income, how it is applied is irrelevant. There will be taxes on accrual of income. If the source of income is itself is given up, even before the accrual of income, the same will not be taxable, and entries in the books of accounts are not relevant. We have to see lot of transaction in that sense. Let's say when you receive the loan which are interest free from someone, question always arises, should the assessee charge interest even in case of relatives, etc., or where the loan has been given, those are interest free. Those things have to be seen from this principle that whether there has been any accrual of income. So justifiably, before any accrual of income could be taxed, there should be an obligation on someone to pay the income, and there along with the right to receive the income from someone. This is the fundamental principle which need to be kept in mind before thinking of taxing of income under section 224. Even then, there are some provisions of deemed income, few of which we have discussed, 250C and presumptive taxation and self-occupied house, that these are the taxable. These are not real income, but these are the income which has been brought by, by the passing of the statute. So that would always override the income accrual because the law has already provided this. So this is the restriction which is to the concept of real income, which we are talking, that unless there is accrual of the income and there is obligation on someone to pay that income, it cannot be brought to tax. we have to keep in mind that if the law provides otherwise, then the law has to be followed and the concept of real income will fail. So these are the few provision where the taxing takes place even though there is no real income. Self-occupied house, section 50C case, we see presumptive taxation, 44 AD, etc., gift from non-relative. Now, taking further to decisions of the Supreme Court, Godara Electricity Company Limited, 225 ITR 746 Supreme Court. Now, the fact of this case is that the assessee company was distributing electricity in a particular place, and it has raised the prices. So those prices were challenged by the consumers. The matter went into court, and the court, the assessee won. And even in the High Court, the assessee won against the complaints which were made by. Meanwhile, the assessee has made entries and issued bills of the revised electricity bill, raised electricity bills to the consumers and made entries in the books of accounts. Meanwhile, Minister of State has written to Godara Electricity, the assessee, that look, we don't want this increase in electricity, and you should reconsider the raising of electricity. And the matter was of 1969 to around 1972, and thereafter this assessee company was nationalized. So the question remains of 2-3 years when the revised electricity bill was not recovered and it was only provisions were made. The question arose whether the bills which have been raised by the assessee, revised electricity bills, is that accrual of income? This was the precise question which came before the Honorable Supreme Court, and till High Court, the matter went against the assessee that it was accrual of income because the assessee has already provided for and the bills have been raised, and there is a material certainty because the assessee has won the case against the consumers in the High Court. But the Supreme Court has taken a different view. What it has held, the question whether there was real accrual of income to the assessee company in respect of enhanced charges for supply of electricity has to be considered by taking the probability or improbability of realization in a realistic manner. So one more aspect have been added to the concept of real income, that there has to be realistic assumption that the what provision of income I am making, I am able to recover. So this Godara Electricity has given a new avenue in case of interpretation of income, that probability and improbability of realization is also to be seen in realistic manner. Supreme Court reversed the decision of High Court, holding that there has not been any accrual of income because there is no realistic probability of realizing electricity bills which have been raised by the assessee. Excel Industries, in the same sense, 358 ITR 295 Supreme Court. Very interesting decision. As you know that in case of import licenses, if you fulfill some condition of exports, then you get advance import license. I don't know if that exists today or not. But earlier there was a scheme where you get entitlement of duty-free import once you fulfill condition of certain export. Now let's assume that in 1991, the assessee company, Excel Industries Limited, made some exports and it has got entitlement for import licenses duty-free. And the provision was made in the books of accounts. But no import was made during that year. The imports were made in the next year when that was taken into consideration. But the assessing officer was of the view that because there is a certainty that you will be getting import duty free then the income has already accrued and it has to be taxed. Now, very interesting observation have been made by the Supreme Court that again, this is to be seen from the realistic and practical point of view. Now, how can you be sure that that can be realized in realistically? Suppose there is no imports in next year. Suppose there is a policy change by the government. We cannot say that fully that may be realizable what it has been, which is the assessee's entitled. What Supreme Court has said, applying the three tests laid down by various decisions of this court, namely whether the income accrued to the assessee is real or hypothetical, whether there is corresponding liability of the other party to pass on the benefit of duty-free import to the assessee even without any imports having been made. The improbability or improbability of realization of the benefit by the assessee considered from a realistic and practical point of view. It is quite clear that in fact no real income but only hypothetical income had accrued to the assessee. So here it was held that there is no real income. It's only hypothetical income which may or may not accrue to the assessee. So again, a very relevant decision. Now, there is a decision of State Bank of Travancore which has gone against the assessee on the concept of real income. This is in 158 ITR 102. This is related to interest provision on NPA account. So the bank tried to escape from the provision made and which was credited to a separate account. The claim of the bank that this interest income is not taxable. So there the Supreme Court has taken a different stand. What the Supreme Court has said, once you provide for the interest provision, this is to be treated as income from other sources, income in the act. And the concept of real income cannot be used to defeat the provisions of the act. Once the income is chargeable under the provisions of the act, you cannot bring the concept of real income. What it has held, the concept of real income would apply where there has been a surrender of income, which in theory may have accrued, but in the reality of the situation, no income has resulted because the income did not really accrue. Where the act applies, the concept of real income should not be so read as to defeat the provisions of the act. Mere improbability of recovery. Earlier, we were discussing the practical aspect of the practical and pragmatic view. Here we are talking about the recovery. So one has to distinguish between the accrual part and the recovery part. Whether the feasibility of payment is missing or feasibility of accrual is missing. So mere improbability of recovery where the conduct of the assessee is unequivocal cannot be treated as evidence of the fact that income has not resulted or accrued to the assessee. After debiting the debtor's account and not reversing that entry but taking the interest merely in suspense account cannot be by evidence to show that no real income has accrued to the assessee or been treated as such by the assessee. So in this case, and then again, it was held that where a debt has become bad, deduction in compliance with the provision of the act should be claimed and allowed. So where there has been accrual but not received, you can claim the bad debts or deduction, whatever is allowed under the provisions of the act, but you cannot say that there has been no accrual of income. Another interesting decision to understand the concept of real income is 225 ITR 703 Supreme Court UP Interstate Industrial Development Corporation. The fact of the case is that UP State Industrial Development Corporation was acting as an underwriter also for public issues of certain companies. And it was underwriting shares at the time of public issue. Now, what has happened in one case that the issue could not be subscribed. So let's say of one company, it was not subscribed and it was called upon to subscribe. And as you know that in case of underwriting, if there is a short subscription, then the assessee has to
परचेज 18%, सेल 18%, स्टॉक 18% बस ये तीन ही आइटम होगी चौथा
I think some
Praveen sir, I request you to kindly switch.
some speaker is open. I would request that please mute it. So the assessee was acting as an underwriter. So one issue, in case of one issue, the issue failed and it has to subscribe, let's say for hypothetically 1 crore of 1 crore of rupees shares it has to take. But as per the condition put down in the agreement, the assessee would get underwriting commission on the share subscribed also. So let's assume 1 crore amount was there and 5 lakh was the underwriting commission. What assessee has done that it has only taken as an income of 95 lakh. 1 crore as the investment, total investment in share, take underwriting of share, less the commission 5 lakhs. Now, in the course of assessment, the AO was of the view that look, your investment is rupees 1 crore. You are subscribed for 1 crore. So you take it to the income. This will be your income. And 5 lakh, that will be the cost of investment. And 5 lakh would be your income, which is to be taxed. So this was the fact of the case. Finally, it came before the Honorable Supreme Court. What Supreme Court has held, this is a little different from bookkeeping entry, but we are talking about that these are not decisive. What Supreme Court has held, but once there is a principle of accountancy available in underwriting accounts, then these principles cannot be rejected and that has to be followed. What Honorable Court has held, in the present case, the tribunal, after referring to authoritative books on accountancy, has found that the assessee was maintaining the accounts correctly in accordance with the principle of accountancy applicable to underwriting accounts. And keeping in view the said principle, the underwriting commission on the shares which were not subscribed by the public and were purchased by the assessee could not be treated as profit earned by the assessee. So there was accounting standard. Probably it was issued by the ICI, which was available. Then the same has to be followed irrespective of any provision in the Income Tax Act. So this is little deviation that book entries are not decisive. If there is no contrary provision in the Act, then it has to be followed. And in that case, it was held that the assessee is not chargeable to tax on the amount of rupees 5 lakh, which was the income which was reduced from the total amount of investment. Tuticorin alkalis. Again, this is the case which gone against the assessee. The principle of real income, few cases against the assessee, few in favor of the revenue. Tuticorin Alkali Chemicals and Fertilizers Limited versus CIT 227 ITR 172 Supreme Court. This is the decision which is mentioned by the revenue in many of the cases. The fact of this case is that the assessee has gone for the expansion of its unit and it has borrowed certain funds from the financial institution, and those were remained idle subject to purchase of capital assets. So let's assume that 100 crores of funds it has borrowed and 30 crores remain idle subject to purchase of assets. Those 30 crores were invested in securities or fixed assets, fixed deposits, and certain interest was earned on that. The assessee made a treatment by reducing the contention of the assessee was that this is part of the pre-incorporation funds. So pre-operation funds. So it has to be reduced from the total expenses and not to be taxed separately. Whereas the contention of the department was that as per provisions of the Act, whatever income is earned on the fixed deposits or investment, it has to be treated as and taxed under the income from other sources under Section 56 of the Act. And mere fact that you have not started your business will not make any effect. And because those expenses which have been incurred before the operation of the plant is to be capitalized, but there is no provision of capitalization of the income or reduction from the capitalized expenses, and therefore it has to be taxed separately. Matter went to Supreme Court, and Supreme Court has held that it is to be taxed not on the concept of the real income, but on the basis of the law provided under the Act. What Supreme Court has held, but this is an entirely different case. Whether a particular receipt is of a nature of income and falls within the charge of Section 4 of Income Tax Act is a question of law, which has to be decided by the court on the basis of the provisions of the Act and interpretation of the term income given in the large number of decisions of High Court, the Privy Council, and also this court. It is well settled that income attract tax as soon as it accrues. The application or destination of the income has nothing to do with its accrual or taxability. It is also well settled that interest income is always of a revenue nature unless it is received by way of damages or compensation. So in this case, the concept of real income was rejected and it was held that this is taxable. Very recent Supreme Court decision 404 ITR 409 Supreme Court on the concept of real income. In this case, what assessee was doing that it was giving assets on lease. So let's say there is a 5-year lease, and at the end of the 5 years, it was taking money in installment. And at the end of the 5 years, when the complete payments was made, it was to be transferred to the lessee. So let's say assume ki there is an asset of 1 crore. So 20 lakhs is the EMI which is to be paid, monthly annual installment which is to be paid, and at the end of the year, and the assessee might be charging, let's say 30 lakhs. So 30 lakh into 5, 1.5 crore. So 550 lakhs is the interest. And at the end of the 5 years, it was to be transferred to the lessee. So what assessee did that because the payment of installment also contained the principal, it has made a separate lease equalization fund. And the part of the principal was transferred on proportionate basis to that lease equalization fund, which was to be used to reverse the asset at the end of the 5 years. The department was of the view that because this is not, this is the against the capital asset which has been transferred in value, and therefore the entire difference is to be treated as income on the income arising from the transfer of the capital asset, even though it is not, because it is not still transferred. But there the court has held that it is to be taken in, and there is no mechanism. Another part was that there is no mechanism in the Income Tax Act to address this issue, and there is no standard which has been issued by the revenue. So it has to be taxed on the principle of tax or income from other sources, interest part to be taxed fully. There the court has held that in the present case, the relevant assessment year is 1990-2000. The main contention of the revenue is that the respondent cannot be allowed to claim deduction regarding lease equalization charges, since as such there is no express provision regarding such deduction in the IT Act. However, it is apt to note here that the respondent can be charged only on real income, which can be calculated only after applying the prescribed method. The IT Act is silent on such deduction. For such calculation, it is obvious that the respondent has to take course of guidance note prescribed by the ICI if it is available. Only after applying such method, which is prescribed in the guidance note, the respondent can show fair and real income which is liable to tax under the IT Act. Therefore, it is wrong to say that the respondent claimed deduction by virtue of guidance note. Rather, it is only applied the method of bifurcation as prescribed by the expert team of ICI. And then it was the appeal of the revenue was rejected by holding that the as per concept of real income, it is to be taxed insofar as not contrary to the provisions of the Express Act and on the basis of the guidance note of the ICA insofar as available. Now, in case of similar lines, United Commercial Bank versus CIT 240 ITR 355 Supreme Court, again the concept of real income was considered. In this case, what has happened that the assessee in 1 year made there was changes in the regulation, and earlier it was making the balance sheet on the basis of cost or market value, whichever is lower, showing investment at cost or market value, whichever is lower. But then afterwards, there was changes and it has made balance sheet as per the Banking Regulation Act. The Banking Regulation Act wanted to make the balance sheet showing the investment at cost and not cost or market value, whichever is lower. So what the assessee did that it has made the balance sheet as per the Banking Regulation Act showing the investment at cost. But then while filing the return in computation of total income, it has reduced the diminution of investment in the computation of total income. So let's say that there was 500 crore of investments and the market value of the same fallen to 430 crores. So what it did that 70 crore, it has made balance sheet as 500 crore, but while filing computation of total income, filing ID return in computation, it has reduced 70 crores as the diminution of investment in the computation. It was opposed by the revenue that the assessee cannot follow the two methods, one for the companies or Banking Regulation Act and other for the income tax. There again, applying the principle of real income, what the Honorable Court has held, Supreme Court in United Commercial Bank 240 ITR. Preparation of the balance sheet in accordance with the statutory provision would not disentitle the assessee in submitting the income tax return on real taxable income in accordance with the method of accounting adopted by the assessee consistently and regularly. That cannot be discarded by the departmental authorities on the ground that the assessee was maintaining the balance sheet in the statutory form on the basis of the cost of the investment. For the purpose of income tax, as stated earlier, what is to be taxed is the real income, which is to be deduced on the basis of the accounting system regularly maintained by the assessee, and that was done by the assessee in the present case. So another fine judgment on the issue of real income. On some different ground, it was the case of in CIT versus Seetal Das, Tirath Das 41 ITR 367 Supreme Court. Now we are going to discuss another aspect of real income, the diversion by overriding title, where the accrual was transferred, where the assessee was not eligible to accrual itself. So it is need to be seen in every issue, in every matter, that whether there remains any diversion by overriding title and whether no accrual has been made to the assessee. One interesting decision was earlier Raja Bijoy Singh Dudaria, but this was discussed in Seetal Das Tirath Das 41 ITR 367. So there was a court decision and the assessee was supposed to pay alimony to her wife, his wife, of I think 18,000 per month alimony was given to his wife. what assessee did in the filing of return, that it has reduced this 18,000, saying that it has no right to that income because it was to be transferred to his wife. And for that, the assessee has taken support of decision in case of Raja Bijoy Singh Dudaria versus CIT 1 ITR 135 Privy Council decision. Now, fact of that case was that there was a charge, there is a court decision, and there was charge on the assets of the Raja to pay alimony to his wife. So, whatever income was coming, first it has to dispose of, because there was charge on the asset. It has to, in certain ratio, what settlement was reached, it was to be given to his wife. So, on that premise, here the Mr. Seetal Das claimed that there is no income accrued to the extent of 18,000, which I have given to I am giving to my wife. That the court has said that whereby the obligation income is diverted before it reaches the assessee, it is deductible, even before it reaches to the assessee. But where the income is required to be applied to discharge an obligation after such an income reaches the assessee, the same consequences in law does not follow. It is the first kind of payment which can truly be excused and not the second. The second payment is merely an obligation to pay another a portion. So you understand what is happening? That in the first case, there is a charge on the assets itself. Assessee can't help it but to give it straight away. And there is no right on that amount. But in the second case, there is no charge on asset, but it has only obligation. And that obligation was to be met after it has already earned income. So here, no deduction was allowed, that it has already accrual of income has taken place. The income has taken place. And this is what you are doing is the application of income, and not there is a diversion of by overriding title. On the similar line, there is an interesting case. You may note down Murlidhar Himasinka and others. Another versus CIT 62 ITR 323. It's a very interesting case of sub-partnership. What has happened in this case? Suppose there was partner ABCT. What AOA has done, that it has given its partnership to another third person. Is say, let's say A1, A2, A3 by another sub-partnership. And this was done without the knowledge of other partners. While making assessment is filing of on return, whatever the share was received by the assessee, it was reduced. And it was said that there is no right of the assessee on that because it has to go to the partners of the sub-partnership. And those partners' return was filed accordingly. Here, the court has held that this was the case of diversion by accrual or at source by overriding interest. Even at the point of accrual, it was diversion. What it has held, the object of section 23(5) is not to assess the firm itself, but to apportion the income amongst the various partners. After the income has been apportioned, the ITO has to find whether it is the partner who is assessable or whether the income should be taken to the real income of some other person. If it is the real income of another firm, it is that firm which is liable to be assessed under section 23(5) of the Act. So another very fine judgment. So even in that case, it was held that even it will not affect to be held as Benamidar. Even if you say that he was Benamidar, still this argument won't help, because what court has held that he was representing A1, A2 and A3. So again, concept of real income was applied. Now again, failed concept, where this concept has failed in CIT versus Sunil as very different decision from what we have seen just now. 259 ITRs 10 Supreme Court. Here there was little twist in the fact. Here the assessee has assigned the profit to a trust, where the entire profit was to go to a trust. So here the different finding was given by the Honorable Supreme Court, that there is a twist in the fact that there is no diversion by overriding title. Here, he is only committing whatever profit would be coming, it would be going to the trust. It is not a case that he is earning for the trust or he is representing to the trust. So in this case, that concept of real income was not applied, and the decision of the High Court was reversed by the Honorable Supreme Court. One interesting and very important decision and relevant decision for today's context, you can write down CIT versus Balveer Singh Mani and others, 398 ITR 531 Supreme Court. It can work in many situations. This was the case where the joint development agreement, which was made by the assessee with the builder, did not work out. So what has happened that there was certain compliances could not be made by the builder. Now the case of the department was that once you have entered into agreement and passed on the position also, position was given to take permission and all that, and there is a valid agreement on the place, there is a transfer, then there is a liability of capital gain. Here the Honorable Supreme Court has held that there is a visibility, there has to be visibility of earning for the assessee, and it cannot be taken as hypothetical manner. I think we're running out of time. I may just read it fast. In the facts of the present case, it is clear that the income from capital gain on a transaction which never materialized, in this case it didn't materialize, is at best a hypothetical income. It is admitted that for want of permissions, the entire transaction of development envisaged in the JDA fell through. In point of fact, income did not result at all for the aforesaid reason. This being the case, it is clear that there is no profit or gain which arises from the transfer of a capital asset which could be brought to tax under Section 145, read with Section 48 of the IT Act. Bombay High Court decision, very interesting, I think, last decision which we are discussing in case of Dinesh Vajirani, writ petition number 2475 of 2015. It was pronounced on 18th April of 2022. It was a Bombay High Court decision. Very interesting fact. In this case, what the assessee has done, that it has sold shares of one Konecranes Finance Corporation under a special purpose agreement, SPA. So the condition of the agreement was that the out of the consideration certain amount was kept, which was to be kept in escrow account, and it was to be kept for 2 years, and it was released on completion of 2 years, provided there is no liability on the promoters towards the specific indemnity obligation envisaged under the SPA. So assessee was a promoter of the company. It has transferred its shares to the purchaser. So let's say for 150 crores total transaction value, so 30 crore was kept in escrow account, which was to be paid after end of the 2 years, and any liability out of that to be set off from that. Now the assessee has filed income return with that 150 crore income, but what has happened meanwhile, that the amount, certain amount of 9.17 crore was held to be payable by the transferee, to whom purchaser, to whom the transfer was made, and it was the rest of the payment was made to the assessee after deducting of that amount. The assessee has gone before the CIT under Section 264 to revise the return and claimed that it has never accrued to the assessee. It was never accrued to the assessee, and it was held to be diversion by overriding title, because it was to be remained in escrow, and in case some settlement was to be made, it was made to be and what Supreme Court has held, the amount of INR 9.17 crore was neither accrued nor received by the promoters and was withdrawn from the escrow account. Therefore, such amount cannot form part of the full value of consideration for computing the capital gains. The consideration under the SPA was not an absolute amount but subject to certain liabilities as provided under the SPA itself, and therefore the full value of consideration will be the amount ultimately received by the promoters. Here the High Court has relied on the decision of which we have discussed on Honorable Supreme Court in the case of Shurji Vallabh Das and Company, 46 ITR, a very landmark judgment, 46 ITR 144, and applied the real income principle to held that the consideration was neither accrued nor received, cannot be brought to tax. So this is the concept of real income, which where you don't go by the what is not there or not there in the act, but go by the realistic assumption, whether there is accrual, whether there is any practical and feasible chances of receipt of income, and so many different aspect what we have just now discussed. So in that context, you can determine some specific queries which we get on day-to-day affairs that which I have discussed, that let's say interest-free deposit is there, interest-free loan, or there are shared premises, or we are providing some free services. There you have to apply these principles, that whether there is accrual, then is there any obligation on someone to pay that accrue the income, and is there any right to receive the income, and then there is a feasibility and practical and on pragmatic approach that income can be recovered. So that has to be taken into consideration. So that concludes my presentation, concept of real income. Any question, I am free to take. Please.
Good evening, everyone. Before we proceed forward, we are delighted to open the floor for a question answer session. We have received a question from our live viewers. So, with your permission, may we now request you to kindly address the queries and engage in this interactive exchange. Sir, can I take the question, sir?
Yes.
Yes, sir. So I have received one question from CA Neelakantan from Chennai, and he wants to ask, how is normal income different from real income?
Normal, as we have discussed, that the real income, normal income is what we see in the act, what is defined in the 224, or the different heads of income, 5 heads of income which are there in the real income, is something which is not expressly there, because income is of wide connotation. There can be various types of income which you don't see that in the list of income, but can still be income. When those type of transaction comes before you, then you have to determine whether it will fall in the provisions of 224, or it will remain out of the provisions of the act, applying the provisions of real income, theory of real income, which we have discussed on different aspects, whether there is accrual, there is certainty of receiving the same, or is there any obligation to pay on someone, and there is any right to receive that income on those aspects. So that way, this is different from the normal income.
Okay, thank you, sir. Due to shortness of time, we will not be able to take any of the further questions, and it gives me great pleasure on behalf of the CP committee of ICI to extend our heartfelt thanks to CA Nikhilesh Kataria ji for his thought-provoking session on the concept of real income under income tax. Your articulation of its underlying principles and practical relevance has added tremendous value to our collective understanding, especially in the context of fair and just tax interpretation. This session has not only deepened our appreciation of real income as a judicially evolved principle, but also highlighted its critical role in aligning income recognition with economic reality. I would also like to thank all our participants for the engagement and the organizing team for the impeccable coordination. As we transition into our next session, let's carry forward this spirit of curiosity and learning. Thank you once again, CA Nikhilesh Kataria ji, for your enriching insights. Now, moving forward, we have with us CA Praveen Mafatlal Pariharji. He is a practicing chartered accountant with over 10 years of experience in project finance, business consultancy, and taxation. He is certified in GST, forensic audit, concurrent audit of banks, MSME, and startups, and more. He has taken multiple sessions and is a regular guest speaker at state level summits and professional forums across Rajasthan. He has an extensive experience in statutory and concurrent audits for major banks and government-linked entities. I would like to request Praveen sir to kindly take the mic and proceed for his deliberation. Praveen sir. I think there is some technical difficulty.
Praveen sir, we'd like you to kindly address the session, sir. You can continue from here.
I think there seems to be a technical difficulty where he's not able to join our session. Meanwhile, I think I should a session. The next session is on the opportunities for CAs in Agri Fund, Agri Infra Fund, and PMFME. CA Praveen M. Parihar is from Jodhpur. He's going to join us shortly.
Just a quick confirmation. Sir will be joining in another 1 to 2 minutes. There is some technical glitch. He'll be available in another 2 minutes.
Okay, no issues. It is a pleasure to inform the viewers that we have right now around 900 registrations total in this for this webinar, and it is an overwhelming response for this webinar. So I thank everybody who has made this webinar successful.
ये डोर बंद करना है ना, और किसी को पेंट बंद करना। हेलो।
Perfect, sir. It's audible. You can continue from here.
ओके, आई एम ऑडिबल।
Yes, sir, you are
It's
audible, sir.
audible, sir.
ओके, so we are talking on scheme of central government like AIF and PMFME. So I am taking first of all PMFME. So sir, how many participants are there?
Sir, we have around 900 registrations right now.
Okay, I am not able to see. That's why I'm asking.
So actually, these participants are from the organizing team.
Okay.
They have joined from a different registration link, and that's the reason they're not visible over here. However, their questions would be available with Nitin sir, and will be taken up at the last, sir.
So let's start with the PMFME. So PMFME is a scheme of central government. Uh, Full form is PM Formalization of Micro Food Processing Enterprises Scheme. This is a small scheme of central government. So this scheme was released by central government on 1st of April 2020. And the purpose of scheme and objective of the scheme is to enhance micro unit of food processing. लाइक बहुत सारी ऐसी छोटी छोटी मतलब फूड प्रोसेसिंग यूनिट होगी जिनके पास में मॉडर्नाइजेशन नहीं होगा, टेक्निकली वो लोग साउंड नहीं होंगे. सो सेंट्रल गवर्नमेंट ने ये स्कीम लॉन्च करी थी कि
Sir, I request you to kindly be speaking in English only because our medium of the webinar today is English only. So we have viewers all over the world that wants to listen in English. I request you, sir. Thank you.
okay sir. So the object of the scheme is the increase access to credit by existing micro food processing enterprises like FPO, small units, SHG, cooperatives, etc. Second objective of the scheme is integration of the existing unit with supply chain by extending branding and marketing. Third one is support for transition of existing 2 lakh enterprises into formal framework. Fourth one is increased access to common services like common processing facility, laboratories, storage, packing, marketing and services. And at the initial phase of the scheme, government envisages an outlay of 10,000 crore over a period of 5 years from 2020-21 to 2024-25. The expenditure under the scheme would be shared in 60-40 ratios. Like if government is paying a enterprises 10 lakh rupees subsidy in the scheme, in this proportion 60% will be shared by the state government and 40% by the central government. Central government shall collect the fund from state government and central government pay itself to the enterprises. And coverage of the scheme is under this scheme 2 lakh micro food process unit will be directly assisted with linked subsidy, credit linked subsidy. There is a concept as on that date this concept has been eliminated, but I would like to elaborate. One district, one product. Scheme adopt one district, one product approach to reach the benefit of skill in terms of procurement of imports, availing common services and marketing of products. ODOP for the scheme will provide the framework for value. Government has decided one product for a district. Like every state of the country, government has decided a district, and a district which is famous for a thing or famous for a food. So government has decided that food for that district. That's why government has decided one product from a district. But as on the date, one district, one product has been eliminated from the scheme, and all the food processing unit are eligible for this schemes. Okay. So government is providing assistance in this scheme to establish new unit, to enhance existing unit, support the individual and group of micro and enterprises, branding and marketing support, support for extending institutions, setting up robust project management framework. What is the support in this scheme? So support to the individual micro enterprises. Individual micro enterprises, food processing unit would be provided credit linked capital subsidy at the rate 35% of eligible project, cost with a maximum ceiling of 10 lakh rupees per unit. Beneficiary contribution would be minimum of 10% of project cost, with balance being loan from the bank. Meaning thereby is government will provide 10 lakh rupees subsidy to a unit maximum, and if you are calculating the project cost, it will become 30 lakhs. So if you are establish a project which is costing amounted to 30 lakhs, then you may go for PMFME, and you would be eligible for 35% capital subsidy, and maximum cap will be 10 lakh rupees. And for any loan, the first concept is of margin money, promoter contribution. So if you are going for loan, you will be eligible of 90% loan for your cost of project. So there is no benefit. First of all, you will eligible for 10 lakh rupees subsidy for a project cost of 30 lakhs. I would like to clarify that your project cost may be more than 30 lakhs or 35 lakhs, or even more than 50 lakhs, maximum up to 100 lakh in 1 CR. But you will be eligible for capital subsidy up to 10 lakh maximum. So what is the eligibility criteria? Eligibility criteria for individual micro enterprises under this scheme is existing micro food processing unit in operation. Existing units should be those identified in SLUFP for ODOP. But as on date, ODOP has been eliminated. That's why I am not taking this. The enterprises would be incorporated as should employ less than 10 workers. Yes, this scheme for micro units. So if you have worker more than 10, then you will not be eligible for here. So your enterprises should incorporated, or your employee should be less than 10. The enterprises should preferably be involved in the product identified in the ODOP of the district. This line has been eliminated. The applicant should be have ownership right of enterprises. मतलब जो entrepreneur has a ownership of the enterprises. Ownership status of the enterprises could be proprietary or partnership. So in the PMFME scheme, partnership firm and proprietary firm is eligible for this scheme. The applicant should be above more than 8 years. This is the normal condition. Only one person from one family would be eligible for obtaining financial assistance. This is the condition. In this scheme, from your family, full of family like wife, husband, and son, only one person from the family would be eligible for obtaining subsidy in this scheme. If any person from your family has already taken the benefit of this scheme, then you would not be eligible for another subsidies. The family includes self, spouse, or children. Your father and your brother may take benefit of this scheme. So if you're willing to take benefit of this scheme, and if you have already taken the benefit of this scheme in another name, then you have an option to take the benefit of your in the name of your brother, your mother, your father, your sister. Willing to and other condition is willingness to formalize and contribute 10% of project cost and obtain bank loan. So you should have 10% margin money to establish your project. So if you apply for bank loan, and if bank is providing you 90% finance, then you would be eligible for this scheme. Cost of land should not be included in the project cost. When you are preparing your project reports and you are deciding your project cost, then cost of land should not be included in this cost. So project cost of land is not eligible in this scheme. So project cost should be up to proportion. First of all, plant and machinery, and second one is building. So cost of if you are going for land, then cost of land will not be part of the project cost. Meanwhile, cost of land shall not be a element of your project cost. Cost of the ready build as well as long lease or rental work shed would be included in the project cost. If you are going to construct a shed on your own land or other leasehold land, you would be eligible for work shed cost. Rental or work shed to be included in the project cost. Your construction cost will always be eligible for project cost. Next concept is what is the selection process for individual micro unit. If you are applying for PMFME scheme, then you should have a question that what is the process to select the unit and which unit will be beneficial or which unit will be selected for the benefit. Then the process I will telling you, identification of existing unit. So process is identification of existing unit to be supported would be a two-way process based on the one product. So one district, one product has already been eliminated from the scheme. So I would not be going there. Application would be invited at the district level on ongoing basis for unit. So if you are going for apply to the PMFME scheme, you have to apply through districts. So they have structured their structure like you have to go for district wise. Application would be invited at the district level on a ongoing basis for a unit. So there are no any time limits when to apply and when not to apply. Like you have gone through the PM KSY, Pradhan Mantri Krishi Sampada Yojana. There are the time limit, time bearing, and budget leveling. There are not like that anything. This scheme is ongoing basis. You can apply anytime. So application would be invited at the district level and ongoing basis from those interested in availing benefit under the scheme. Resource person would undertake survey of various cluster and identify unit that in this scheme there are a concept of DRPs, district resource person. I am also a DRP of various districts. So you district resource person, what is the work of district resource person? District resource person will survey the area which has been given to them, and he will undertake the survey of various area, cluster or unit. And if you are applying for the PMFME scheme, you have to apply online and then you have to contact to your DRP. DRP may be more than one in your district. So you have to select the DRP and your application and documents should send to the DRP. So DRP would undertake survey of various cluster and identify unit that show potential for availing benefit under the scheme. For application received directly, DRP would undertake filed verification and due diligence. You may apply directly to the PMFME portal. And what will that DRP do? DRP will scrutinize your application, which has been sent to the department by the department to the DRP. DRP, what the work will be DRP? DRP will process your application and forward to the district level committee. All the potential cases based on the identification of unit directly by RP and application receipt would be submitted before the district level committee. So DRP will scrutinize your application, complete your application, and after the verification of all the document and completion of process, the DRP shall forward your application to the district level committee. Achha, what is the district level committee? I will brief you in the later on in this session. So district level committee should study the report submitted by the RP. And one thing is, when that DRP will scrutinize your application, DRP will scrutinize your application and prepare a report of him. And this report will be sent to the district level committee. And district level committee should study the report submitted by the RP of each unit and interview the interested person. If when the your application is scrutinized by the DRP and DRP send this to the district level committee will do your report submitted by the RP, scrutinize your report, and if fits for the beneficial unit, then DRP will, district level committee will interview the interested person. Okay, what due diligence to be carried out by the resource person for each unit? So, okay, I am telling you the work of the DRP, because CA may become a DRP of the PMFME scheme. That's why, what is the due diligence? If you are become a DRP of the scheme, what should you do and what due diligence to be carried out by the district resource person? So I am telling you the what is the work and what due diligence to be carried by the DRP. So annual turnover of the enterprises. You should scrutinize the annual turnover of the enterprises. Okay, there is a condition of annual turnover. If your turnover is more than 5 CR, then you are not a micro unit, and you will not be eligible for this scheme. That's why DRP should care that annual turnover of the enterprise should not more than 5 CR. If you are doing for existing enterprises, then annual turnover need to be checked. So that's why annual turnover of the enterprise should not be more than 5 CR. If turnover is of the enterprise is more than 5 CR, then this unit will not be eligible for the benefit, and DRP should not forward the application to the district committee. DRP should also check the track record of payment by the enterprises. If you have any enterprises which are applying for the benefit under the PMFME, then the track record of repayment of the loan of the enterprise should not be paid. Track record of the applicant should be good, even better. So that's why DRP should check the track record of payment of the enterprises. Any loan which is taken by the unit before the application of the PMFME, then DRP should track all the application that DRP need to check if all the payment has been made by the enterprises on the timely basis. Okay, DRP should also check the existing infrastructure of the unit. Applicant which are apply for the PMFME benefit, then DRP should check the existing infrastructure. If infrastructure is more than the eligible under the PMFME scheme, then DRP should not forward the application to the district level committee. Backward and forward linkage to be checked, and marketing leakage of enterprise need to be checked by the DRP. So for the cases recommended by the district level committee, DRP should help them in prepare. What will be the work of DRP? So work of the DRP is DRP should help them in the preparation. DRP has also a work of help to the applicant. So district resource person should help them in preparation of application, preparation of DPR, availing bank loan for upgradation of the unit. The DPR along with necessary documents should be submitted to the bank for the sanction of plan. So DRP has also work in this scheme. DRP need to help in the application, and DRP need to help in the preparation of DPR and other document which is need to be submitted in the application. So this is also a work of DRP. DRP will assist the promoter applicant in the whole of the process of application of under the PMFME scheme. The procedure delineated would apply for selection of new unit also. PMFME, in the PMFME scheme, there are existing unit as well as new unit both are eligible under the scheme for the benefit of PMFME scheme. So new applicant, new unit is also eligible, and existing unit is also eligible under the PMFME scheme. Other category is group category. We have discussed earlier is a individual category. Now we are discussing for group category. The scheme would support cluster and group such as FPO. Scheme is also for not for individual, but this is also for group like FPO, SHG, producer cooperative, and other entire value chain for sorting, grading, assaying, sortage, common processing. Any group category like FPO, SHG, producer company, cooperatives which are going for apply under PMFME, they are eligible for that. And the activity eligible is entire value chain for sorting, grading, assaying, storage, common processing, packaging, marketing, processing of agri produce, and testing laboratory. If you are going for these activities, you are eligible for PMFA scheme for group category. So, what is the benefit for group category? So, first of all, FPO producer company. If your applicant is a FPO or producer cooperatives, then what will be benefit? FPO and producer cooperative would be provided the following support by this scheme. First of all, grant at the rate of 35% for credit linkage. Meanwhile, 35% of term of loan amount. Training support will be provided under this scheme. Maximum limit of grant in such case would be prescribed in after that, and till the date no limit has been prescribed. Eligibility criteria for cooperating in FPO. So this will be the condition. First, it should be preferably be engaged in the processing of ODOP produce. This is not a condition as on the date. It should have minimum turnover of 1 CR. Listen, in the individual category, there are a condition of maximum turnover of 5 CR. If your turnover is more than 5 CR, you are not eligible. And in the group category, there is a scheme of minimum turnover of 1 CR. If your turnover is below 1 CR, you are not eligible. And if your turnover is more than 5 CR, you are eligible. So in the group, you have to decide if your category is individual, your turnover should not be more than 5 CR. But if your category is group category, then minimum turnover should be 1 CR. And if your turnover is more than 5 CR, in that case, you are also eligible in this group category under the PMFME scheme. So your minimum turnover is 1 CR. This is the condition. If you are going for a PMFME application, your turnover should be more than 1 CR. The cost of project should not be larger than the present turnover. If you are going for a group category and if your project cost is more than your turnover, last year turnover, in that case, you are not eligible in this scheme. Your project cost should not be more than your last year turnover. So you should have also considered this point. If your turnover is below 1 CR, you are not eligible. And if your turnover is more than 1 CR, but your project cost is also higher than your last year turnover, then also you are not eligible. So you should have to keep in mind, first of all, you should have a turnover 1 CR, minimum turnover of 1 CR, and your project cost should not be more than the turnover which you have achieved in the last financial year. The members should have sufficient knowledge and experience in the dealing with the product for a minimum period of 3 years. There is also a condition in the group category. This condition is not in the individual category. There is a condition in the group category. Your member should have experience of at least 3 years in the category, in the activity which are going for in the apply for under the PMFME scheme. The cooperative FPO should have sufficient internal sources or sanction from the state government to meet 10% of project cost. If you are going for group category, you should have margin money is same in the both cases, individual and group category. In the individual cases, individual should have 10% margin money, but if you are going for in the group category, your member of the group should have 10% of the project cost and margin money for working capital. Another category is self-help group. SHG, a number of SHG are undertaking processing activity. The scheme proposed to provide following support to the SHG. SHG is also a category which is eligible in this scheme. So what benefit will be availed by the SHG if apply for PMFME? In the PMFME, SHG is eligible for seed capital at the rate 40,000 per member of SHG for working capital, and purchase of small tools would be provided under this scheme. If you are operating a SHG group and if you are apply for a PMFME scheme, you will be eligible for seed capital 40,000 per member for working capital, not for infrastructure and plant and machinery. So if you have 10 members in your SHG, maximum 10 members are allowed. So if you are apply for the PMFME, you would be eligible for 4 lakh rupees as a grant, as a seed capital, which is non-refundable. You have not to refund to the government. And other benefit is priority would be given for SHG involved in ODOP. ODOP has been eliminated from the scheme. All the member of SHG may not be involved in the food processing. Therefore, seed capital would be provided at the federation level of SHG. This would be given as a grant to the SHG Federation by SNA, SLRM. SHG Federation would provide this amount as a loan to the member of SHG to the if you are receiving benefit from PMFME scheme as a seed capital, then SHG Federation would provide this amount as a loan to the member of SHG to repay the SHG. What would be support to the SHG member as a single unit of produce processing industries with credit link of 20% with maximum amount being rupees 10 lakh. In addition to the seed capital, SHG is also eligible for capital subsidy of rupees 10 lakh. If any SHG apply under the PMFME for a establishment of unit or enhancement of PMFME micro unit, then this SHG unit will be eligible for 35% capital subsidy in addition to the seed capital of rupees 4 lakh. 40,000 per member. If you have a 10 member in the SHG, you will also eligible for 4 lakh as a seed capital. And in addition to that seed capital, you will also be eligible for 10 lakh rupees as a capital subsidy for an establishment and enhancement of your unit. Support for capital investment at a federation of SHG level for with credit link grant at 35%. Maximum limit of grant in such case would be prescribed. As on date, the limit has not been prescribed by the government. Training and support to the SHG. If any SHG apply for a training and hand-holding support for SHG, then government will also provide a large number of trained resource person with state rural livelihood mission, and that person may be made available for the SHGs. What is the eligibility criteria for seed capital for SHG? So you need to check. You need to check before apply what is the condition which will be eligibility. So only SHG member that are presently engaged in the food processing would be eligible. Any SHG which are not involved in the food category or food processing unit, they are not eligible for this scheme. If any SHG which is involved in the food processing activity, only that SHG is eligible in this scheme. The SHG member has to commit to utilize the amount for working capital and purchase of small tool and give a commitment in this regard to the SHG and SHG Federation. So any SHG which is applied under the PMFME scheme has to provide affidavit to the authority that the seed capital which is being provided by the scheme to the SHG, that amount will be utilized for the working capital only or purchase of small tool, and give a commitment the SHG will continue the activity or commence the food activity under this scheme. Before providing the seed capital, SHG Federation should collect the following basic detail for each of the member. Detail of the product being processed. Before application under the PMFME scheme, you have to keep this 4 document. First of all, what the product or what the food product you are processing as on the date. So you have to keep the activity, what is your raw material, what is your finished goods, what is your processing activity. You have to keep in a writing mode, or you have to submit. What the other activity other than the food processing activity you are carried out as on the date. Annual turnover, what is your annual turnover, because 1 CR is the minimum limit in the SHG activity. Group category activity in the PMFME scheme. That's why you have to keep the record of the annual turnover of the any SHG. What is the turnover in the previous financial year is which SHG have. So that's why you have to keep the record of annual turnover also. Source of raw material and marketing of produce. What will be the source of raw material and what will be the market how the SHG will market its product. You have to keep the record of that also. Eligibility criteria for credit link grant for investment for SHG. What will be the eligibility criteria? So SHG should have sufficient one fund for meeting 10% margin money. We should have 10% margin money. And if you are going for seed capital, in the seed capital assistance, you have 20% margin money for working capital or sanction of the same as grant from the state government. ODOP has already been eliminated from the scheme. Support for common infrastructure. In the PMFME scheme, there are a support for common infrastructure. Support for common infrastructure would be provided to the FPO, SHG, cooperative, any government agency, or private enterprises. Common infrastructure created under the scheme would also be should also be available for the other unit and public to utilize the hiring basis for substantial part of capacity. Eligibility of the product under this category would be decided based on the benefit to the farmer and industry at large, viability gap, absence of private investment, criticality to the value chain, etc. Credit link grant would be available at the rate 35%. Maximum limit of the grant in such case would be prescribed. As on the date, any limit has not been prescribed by the government. Type of common infrastructure to be funded under this scheme. What common infrastructure can be funded by the under this scheme? So premises for assaying for agriculture produce, sorting, grading, warehouse, and cold storage at the farm gate. Common processing facility, incubation center should involve one or more product. Okay. Next one is procedure for group to send proposal for common infrastructure and capital investment by the. So what will be the process under the PMFME scheme, which should follow by the group category SHG? So the following procedure should be followed by for seeking funding for common infrastructure and capital investment by FPO, SHG, or cooperative under the scheme. ADPR for seeking assistance under the scheme for capital. So you have to make a detailed project report, and in the project report you have to mention you are seeking for a assistance under the scheme for capital investment, and common infrastructure should be prepared. So you have to prepare the DPR, in which you will mention the capital investment and common infrastructure. The DPR should have necessary detail for proposal. In the DPR, you have to consider detail of the proposal, detailed project cost, proposed manpower, proposed turnover, marketing channel, source of raw material, estimated profit and loss account, cash flow, etc. You have to mention in your detailed project report. In the detailed project report, other things also you have to mention, like raw material procurement, your processing plant, your finished goods, your marketing strategy, your sales strategy, your manpower strategy, what will be the power and what will in case of power failure, like all the things you have to mention in your detailed project report. If you are applying and you have applied under the PMFME scheme, a DPR should be sent to the state nodal agency. Your DPR should be sent to the nodal state agency. After approval of the proposal by the nodal agency, SNS should recommend the proposal to the MOFPI, Ministry of Food Processing Industries. If your proposal is considerable, in that case, your proposal will be sent to the MOFI, Ministry of Food Processing of Indian government. Any proposal for assistance to a group for a grant above rupees 10 lakh should be sent to the MOFI for approval. If your assistance is below 10 lakh rupees, then the proposal will be processed at the state level. But if your assistance is more than 10 lakh rupees, then in that case, your proposal for the grant should be sent to the MOFI for approval. And if the approval is granted by the MOFI, the state government shall provide the assistance to the unit. After approval of proposal by MOFI, the proposal should be forwarded to the financial institution for the sanction of loan. Okay, PMFME is a pre-sanctioned scheme. If you are going for any subsidy scheme, there is a two type of a scheme. One will be the pre-sanction and second one is post-sanction. If any scheme which is pre-sanctioned, in that case you have to apply first to the government for assistance. You will provide all the document to the government or government authority. And if the sanction by that authority, your proposal is sanctioned by that authority, in that case your proposal will send back to the bank. in the pre-sanction, you have to first sanction your subsidy scheme and first get approval from the government for the benefit. And if any scheme is post-sanction, in that case, first you have to take loan and you have to start your business. You have to construct your infrastructure and install plant and machinery, all that. And when your commencement of business has taken place, after commencement of business, you have to apply for the subsidy. So there are two type of subsidy schemes. First one is pre-sanction and second one is post-sanction. PMFME is a pre-sanction scheme. In PMFME, first of all, you have to go to the government for assistant sanction. If your authority is sanction your case for assistant under the PMFME or any other pre-sanction scheme, if they are find your case fit suitable, then in that case your case will be sanctioned and forwarded to the bank. And in case of post-sanction, you have to first take loan and you have to start your business. And after commencement of business, you have to apply for subsidy. So in PMFME, DPR after proposal, if you MOFI have sanctioned your case should be sent to the bank for sanction of loan. So in the pre-sanction scheme, you have to take care that you have to first apply for subsidy and you should apply for subsidy and you have to try to get sanction your case from authority, and authority should send this case to the bank for sanction of loan. The DPR may also contain proposal for training support. If you are going for training support or other benefit, then your DPR should consider this content also in your detailed process report. So other benefit is also available like branding and marketing support. Branding and branding support would be provided to the group of SSG, FPO, cooperative or an SPV of micro food processing and under this scheme. Eligibility for support, you have to check the anytime check the eligibility criteria. Your applicant may be individual, applicant may be group, and applicant may be SHG, applicant may be cooperative, etc. Okay, so if you are applying for individual, then you should have to check criteria for individual category. If you are going for group category, then you should have to check criteria for group category. So this is the point you have to check. So there are also procedure for applying for assistant under branding and marketing. If you are going for under the PMFME scheme for assistant for branding and marketing, so there are the procedure which you have to follow. So there are more benefit in the PMFME scheme, but this is for micro unit. If your unit is not micro, you are not eligible here. And if you are micro unit, you are eligible. And what is your unit, like individual or group category, you need to check, and you also need to check in which for what benefit you are applying for. So that's why you have to take care for the eligibility criteria for each of the benefit provided under the PMFME scheme. So in the PMFME scheme, there are also benefit of level technical institution. Okay. Criteria for what is the criteria for state level technical institute, you have to check. There are also training support to the individual or group in the both category, individual or group category. There, if any unit which is micro and they have not the training staff, they do not have any staff, trained staff, then PMFME scheme and their committee have a trained staff. They may provide your staff through agencies or their own. So you may avail benefit of training support to the individual or grant. If you are a staff but who are not trained, then you can avail the benefit of training of staff. So there are the also procedure and also eligibility criteria for that. So you need to check for that. So in the individual cases, there is a subsidy of 10 lakh rupees per case. And in the PMFME scheme, most of the applicant are of individual category. Okay. In the food processing unit, what happened? If you are going for 30 lakh rupees project and you are thinking for establishing shed building and establishing plant and machinery, it is not possible to establish in 30 lakh rupees. So if your case is weak, your project cost is more than 30 lakh, then in that case PMFME is not beneficial for you. But yes, if your unit is not a big unit and not cost of more than not more than 30 lakh rupees, then you may go for PMFME scheme. In the in the PMFME scheme, you have two types of benefit. First of all, for individual, two type of beneficiaries. One of the individual and second one is group category. And in the whole of the PMFA scheme, most of beneficiaries are individuals and small units which are not having turnover more than 5 CRs, and they are taking they want to take only assistance for rupees 10 lakh rupees, then you may apply for the PMFME scheme. This scheme is far better for those units which are existing but not structured, like their activity are not fully automated or manual. Activities are manual and they willing to convert their scheme in semi auto mode, and they are proposed to establish some of machineries, and they are taking increasing their capability and not going for big unit, then they may have beneficial this scheme for those type of applicants. PMFME is a scheme of central government, and it is governed by the MOFI, Ministry of Food Processing Unit. In other than PMFME scheme, there are so many scheme of MOFI like PMKSY, Pradhan Mantri Kanshi Sampada Yojana, Agri Infra Fund. Like these are the scheme which are provided by the Ministry of Food Processing Unit. For the food processing unit, all the scheme provided by the MOFI, which are like PMFME, PMKSY, like Agri Infra Fund. These are the scheme which is operated by the central government under Ministry of Food Processing Unit. So when a applicant apply for a PMFME scheme, you need to go for PMFME portal, and you need to create your credentials, ID and passwords, and you need to apply, and you need to decide whether you are individual applicant or group applicant. When you are creating your profile, you first need to decide, and you need to mention that you are individual category or in group category. If you are applying for group category, then option will be open for group category, and if you are applying for individual category, then the all the option which is related to the individual category will open in the portal. So you need to keep in mind this point when you are creating your profile on the MOFI portal. So this is the most point of the PMFME scheme is this scheme is providing maximum capacity of 10 lakh rupees per case, and if your project is 30 lakh rupees only, then this scheme is beneficial for you. And PMFME scheme is only for food processing unit. If you are going for unit which is not a food processing unit, then you are not eligible for here. This scheme is only for food processing activities. This scheme is also the applicant is also eligible in this scheme if your project cost is up to 1 CR. If your project cost is 1 CR, you may apply in this scheme. And if your project cost is more than 1 CR, then you are not eligible for this scheme. In the initial phase of this scheme, there are the criteria like you should have this type of education and all that, but their criteria has been eliminated in this scheme at the initial level of scheme. This scheme is available only up to the 31st March of 2026. After that, this scheme will be eliminated or maybe extended by the government. But till the date, this scheme is available up to the 31st March 2026. In this scheme, if a unit apply for the benefit, rupees 10 lakh will be provided at a one shot. Meanwhile, your 10 lakh subsidy will be provided in one amount. In one shot, you will be receive 10 lakh rupees as assistance. Okay. There is a concept of 60-40 ratio of the government, like 60% will be funded by the central government and 60% by the state government. But you don't need to care of that, because central government collect from the state government itself, and central government provide the assistance itself from their end. So we do not need to take care of that. What is the proportion of central government and state government? So state government directly provide. Once your application is selected and forwarded to the bank, you don't need to care. You don't need to worry that your subsidy will be provided or not. It will definitely be provided by the government if your application has been selected and forwarded to the forwarded by the department to the bank. So what will be the process? Once your application has been forwarded to the bank will sanction your loan, and bank accept the application from the PMFME portal. There are also, if you have a credential for login and password for application, then bank will also be will also have a credentials. They need to log in and they need to check which application and what application, how many application they have received by the bank from the department. Once bank sanction the loan, the bank need to mention need to sanction the loan at PMFME portal. They have to mention the PMFME portal whether unit has sanctioned the loan or rejected. If they are sanctioning loan, then they have to select the option that the applicant has sanctioned the loan. And if they are not sanctioning the loan, they're rejecting the case, then they have also been mentioned that the case has been rejected, and also mention the reason for the rejection. And if the loan is sanctioned by the bank, then the application will also goes to send back to the department that loan has been sanctioned by the bank, and the bank will apply for the subsidy to the government. And after applied by the bank to the government will directly pay the bank as assistance amount, the what subsidy is being provided by the government to the bank. And bank, when the subsidy amount is received by the bank will prepare a deposit for the SRF account, and the FD will be made by the bank for the subsidy amount, and this subsidy will be keep as FD by the bank for a period of 3 years. Three years is a block period for the subsidy amount. If your unit is closed or loan is not paid at the right proper track record, in that case subsidy will be returned back to the government. So you need to keep in mind, or applicant need to keep in mind that if you have been sanctioned the case under the PMFME, you have to pay properly your EMI of the loan sanctioned by bank under the PMFME scheme, and you need to carry your business activity or food processing activity at least for a period of 3 years. After the completion of 3 year of period, this FD amount and subsidy amount will be released to your term loan account. So this is the PMFME scheme, and you have to apply for or this is the scheme of central government scheme, and a small unit can apply for that scheme. Thank you.
I think, hello, am I audible? I think sir has left, I think. Okay, no issue. So, once again, good evening, everyone. As we come to the close of today's engaging webinar, it is my privilege on behalf of the CP committee to extend a heartfelt vote of thanks to CA Praveen M. Pariyar ji for delivering such an eye-opening session. Your insights into the Agri Infrastructure Fund and the PMFME scheme have not only broadened our professional horizons but also awakened a sense of responsibility in us as enablers of grassroots growth and financial inclusion. The clarity with which you mapped the potential roles for CAs in these national initiatives was truly commendable. My sincere thanks to all the participants for their active engagement and to our organizing team for curating this impactful platform. Let's carry forward the inspiration from today and explore these new frontiers with purpose and vision. As we bring this insightful webinar to a close, I take this moment to express my heartfelt gratitude to the CP committee for their commendable initiative in organizing today's event. A special word of thanks to our chairman CA Satish Kumar Gupta ji and vice chairman CA Vishnu Kumar Agarwal ji for their visionary leadership and continued support that made this knowledge sharing platform possible. Your commitment to professional excellence continues to inspire us all. I also take this opportunity to personally thank the committee for entrusting me with the role of moderator, a privilege that allowed me to be the part of today's learning journey alongside such esteemed faculty and engaged participants. To each one of you who joined us today, thank you for your time, attention, and enthusiasm. Let us continue to grow together in knowledge, purpose, and service. Warm regards, Jai Hind and Jai ICI.